In 2016, the banking sector faced a number of challenges. Among those was non-performing loans. This was considered a major challenge for the financial sector in the last 18 months. But even with an elevated level, those challenges compared with what actually took place in the financial sectors of other regional territories.
And was largely due to the decline in non-oil commodity prices and reclassification of exposures by a few banks.
Governor of the Bank of Guyana, Dr. Ganga, added that non-performing loans remain the focus of intense scrutiny by the Bank of Guyana, as the central bank continued to monitor and encourage financial institutions to implement measures to overcome this problem. Another challenge faced was de-risking. This is whereas financial institutions are restricting or terminating corresponding banking relations with categories of clients to avoid risk.
While foreign-owned banks operating in Guyana have not been subjected to de-risking, locally owned banks have been hard hit by de-risking, losing an aggregate close to 37% of correspondent banking relationships by the end of June 2017. Thus far, the two affected local banks were able to establish new correspondent relationships to cover about 75% of those relationships that were lost. Each bank in Guyana has at least one correspondent bank, and we are currently working with the banks to establish other correspondent banks.
Dr. Ganga added that a major concern with the spate of de-risking is that legitimate transactions may go underground.
The end result is likely to undermine the effort to supervise and regulate the financial sector, fight money laundering, and combat the financing of terrorism.
It was related to that in October 2016, FATF issued guidance on correspondent banking services. The Bank of Guyana is presently conducting a preliminary assessment of how banking practices in Guyana compared with the recommendations of the FATF Guidance will address any gaps found, according to Dr. Ganga. Handel Duncan, HGP Nightly News.